10-year note yields settle at their lowest weekly settle since January of 2018. So it's been a while since we've been down here on a Friday. Likewise, when you add in what the Fed's done since January of 18, the supply we've seen hit the market since January 18, with the lack, I think, of foreign buying, mainly China, since January of 18, it's a surprise that yields aren't higher. It should probably tell you that there's maybe a little bit more to it than just a stock market hedge, or maybe more than just retail buying out there in the bonds. Because I think right now this is a flight to quality bid that is maintained, and we certainly haven't seen a panic buying binge. But certainly I think there's a reason why we're at the bottom of the range and holding at our lowest weekly settle in over a year, despite the fact that over the last month or so the tone has changed from the Fed. I think that is part of it, but not the whole story. And if you look at market volatility, it's low, and it's going lower, and we're basically at our lowest point of the year in 2019. And I think that we're holding the range. So the 260 to 280 range has held. Yeah, we settled just below 260, but when you take a step back, the low for the year is actually closer to 255, but given that first week. But I think ultimately the market's waiting for some catalyst event. It's not necessarily going to be a position trade. It's going to be what happens maybe with Brexit, what happens with China, what happens with U.S. economic data, and possibly our friends at the Fed could be the directors here. Obviously, the Fed wants to keep volatility low when the Fed's involved. As we noted, between 2008 and 2017, volatility was very low. And once they started to loosen up, vols started to go up again, yields started to rise again, and then all of a sudden they talk about stalling the rate hikes, stalling their balance sheet amendments. And it looks to me that that's really causing volatility to just plummet. And that is really the reason we see yields go down, we see volatility go down. Next week, we have a very interesting week ahead of us. Yeah, the Fed meets, and that's going to be a no rate hike meeting, but certainly we'll look at the clarity of what's going on in the economy. Manufacturing data has been question mark, and housing data has had its ups and downs. And I think ultimately here, the Fed has to be more concerned about growth. First quarter growth is expected. It was marked up 0.2 on the Atlanta Fed GDP now to 0.4. Now, this is a number we've been looking at between 2.5% and 3%, and now we're talking about 0.4. So that's got to be something that's going to be, for the first quarter, that's going to be something that's very concerned for the Fed. Likewise, we get the Bank of England meeting. This will be their last chance to opine about the Brexit in an organized setting. And I think that the Brexit will probably get moved down the line. Prime Minister May is looking for a third chance to sell her proposal to Parliament. The first two got knocked down pretty easily and pretty handily. This could be another opportunity for her. Likewise, the vote we saw this week likely will push the red line at March 29th down the road a ways. We don't know exactly when. So those are two events we'll get, the Bank of England and the Fed. However, look at the yield curve. A lot of people looking out the back end of the curve. They aren't seeing a whole lot. 530s continues to steepen. 210s right inside the range at around 15. But what about the 5-year and the 3-year trading below the effective funds rate? When that happens, that's a major signal that not only is Fed tightening over, but Fed easing is around the corner. So right now, that seems to be a bigger concern, that you've got an effective overnight rate trading above the 3-year and the 5-year for that. So that's going to be a concern. Keep an eye on that. They actually settled right around even par on the day, but that will be something that we'll talk about more next week. The Fed is obviously going to be concerned about that, but the Fed really right now has to be more concerned about the data than anything else. If they don't get growth, that's going to really cramp their style if they want to raise rates later this year, which the market right now is telling you isn't going to happen. So it's going to have to come from the economics, and right now it doesn't look real clear. So the Fed has its work cut out for it, but 10-year note yields going out on the lowest we've seen in a long time.